that we've taken a look at my chart of the day. It's time to bring in my next guest. That's going to be Phil Strebel, Chief Market Strategist at Blue Line Futures. Welcome back to the show, Phil.
Yeah, thanks for having me on, Tom. Your chart of the day should have been 2-year Treasury yields because they peaked when crude oil prices peaked, and they'll impact, everything from the consumer loans, things like that, real inflation, and everything else. So 2-year Treasury yields hit 4% when crude oil prices did, and now they're starting to break down. So we'll see how much they retrace.
Yeah, we've seen that yield curve widen out here a little bit, but I just wanted to get your take real quick before we get into a discussion about oil, about maybe the healthy pullback in the equity market that we saw yesterday, just at or near all-time highs. Valuation still elevated at this point, but earnings season's helping out, right?
Yeah, definitely. And I like U.S. equities to the upside. I think it's going to be a melt up. I think that both of the candidates look for stimulative measures here. November and December, historically great months for U.S. equities. I would be a buyer on any kind of dips on here, and I really favor the small caps with those 2-year Treasury yields coming off. So there's a lot of good plays to the upside. I wouldn't be necessarily a bear at the moment. We haven't broken through any key levels that throw up any kind of serious alarm. Some of the Middle East escalation seems to have died down just a touch here. So seems to be a great place to be playing the equities back to the upside.
Yeah, 3.65 or so for that 2-year yield at this point. And we've saw the 10-year kind of come off of those highs back down to 4%. That's actually helping the small caps. That was the only positive indice yesterday, up 9/10 today, the Russell futures at this point. But let's pivot over to that discussion about crude oil. We fell about 4% yesterday. We're basically flat today, just above $70.50 a barrel. But, some of the data that was released out of the IEA and maybe some of the demand concerns putting pressure on crude, right?
Yeah, definitely. So you look at crude oil, the collapse in the past 72 hours, it was OPEC. They cut their demand forecast for 24-25, and then Israel kind of walking back the prospect of hitting Iranian oil and nuclear facilities. So what happens is you look at, if you rewind back a couple weeks ago, remember the money managers and the funds, they all flipped bearish on crude oil. And what they had to do was unwind those bets. They ended up going bullish on it, playing this inflation going back up, playing the escalation and everything else. When you get that crash in crude oil, you get inflation expectations, they come down because there's an interesting dynamic between crude oil, inflation expectations, the strength of the dollar, and Fed policy. So the correlation between crude oil and the dollar right now, about a positive 85%. So we haven't seen that breakdown in the dollar yet, but if we get crude oil prices remaining at this lower level, you should see the dollar index continue to come off, and then you'll see a rotation back into some of those asset classes that do well with a more dovish Fed.
When you look at this, the Fed's dovish at this point, Phil, but at the same time, a lot of the data that's been coming out recently is kind of, reaffirmed the fact that maybe that 10-year yield should be moving higher. You've gotten a widening out of the yield curve at this point, but a lot of the data is not really reflective of that. Inflation is going to continue to move down. It's kind of stabilized here, right?
It has, but if you look at UK CPI, it dropped significantly overnight. I think that if we get the next CPI report will probably be slightly elevated because a lot of these commodities were still trading at higher levels. But if you look at the agricultural markets, they've all collapsed. You look at the energy prices, they've collapsed as well. And that makes up a large component, the food and energy. I think housing prices are a bit stable, but you're starting to see serious pockets where there is some material weakness. I mean, we're actively looking at purchasing a home in a couple different cities, and we're seeing all those getting cut significantly as interest rates are coming down. So I think the spillover effect is, you look at how much bullish bets were put on that crude oil market. I mean, there was even a lot of chatter about $100 calls and things like that. Now all that is being unwound, and those money managers need to go back into asset classes that performed well with that more dovish case. And that's where you get the Russell leading the pack here today. That's where you get bonds leading the pack. And that's where you get gold futures knocking back on $2,700.
Yeah, and that's been the surprising thing to me, because we have seen that rally in the dollar along with yields over the last several weeks here. It kind of capped consolidated gold at this point, but now we're getting back close to, those all-time highs in there, and it seems like the demand for the precious metal continues to grow. And now, is it a diversification type product, or is this, maybe the beginning of something longer term here, Phil?
So historically, it takes about 30 days after that first interest rate cut in order for money managers, wealth advisors, and registered investment advisors to make that pivot. They start going into the small caps. They start adding some of the gold miners and things like that to their asset allocations. Remember, they move a bit slower. That's why that happens. But if you look at central bank purchases, they look like they're set to continue. The average central bank has about 15% of its foreign exchange reserves in precious metals. We just got notification that Mexico, Mongolia, and the Czech Republic are all planning to increase their expansion of more gold and more bullion in their reserves. So we believe that gold is a great place here. We think that we could easily achieve 2850 by year end, especially if you get 25 at the next one, which has a 92% chance of working out. We end up getting some of that inflation data continuing to come down. We should see a 50 basis point cut at that December meeting. And then I think that that's where it really pulls forward in 2025, and we could see 3,000.
Yeah, if you see those falling rates, we're on the rate cut cycle. Expectations for that November cut have been moved down to about 25 basis points at this point. But when you looked at the impact here, I always talk about maybe gold being a safety play with equities overstretched on a valuation perspective. Maybe that push into the dollar as a little bit of a safety play at this point. But when you look at crude oil and the geopolitical effects that aren't really taking hold here, Phil, typically you'd see crude oil up near 80, 90 bucks a barrel if you had all this geopolitical tension that's out there at this point. But is this a demand issue where, hey, oil might not bottom out until we hit that support level around 65 at this point?
Yeah, I think that oil prices should work their way down to about 65. I think that's where you see like longer term value. And the farther out you go, the cheaper crude oil gets. So if you look at March, it's trading about $1.60 lower from the front one November. So that's a little bit of elevation there with geopolitical risk. But if you look at the gold market, gold had little reaction to any of these geopolitics over the last 3 weeks, and that's when the escalation really unfolded. So it told you that there was a big rotation out, and if you look at money managers and funds, they cut their net bullish bets on gold to the lowest level in 8 weeks, and they chase those crude oil prices. So that's why I said there's a redeployment of where things would be at. If things really did get out of control, you would see that $80, $90 crude oil, but how much damage would that do to Israel for making that kind of strike from a sense of they've negatively impacted the global economy because they brought inflation prices higher? And I think that puts them from a standpoint of like how people perceive Israel would be much more negatively impacted. So they don't want to do that whatsoever. So I think that's why being more strategic, taking care of military targets or trying to de-escalate the situation is what the best case scenario is. So that's why crude oil prices hinging at $70. We do have expiration for the November contract on the options in the next day or two.
All right, we'll continue to watch that. Buy dips in gold, buy dips in equities. Like it, Phil. Thanks for the breakdown.
Thank you.
All right, that's Phil Strebel, Chief Market Strategist at Blue Line Futures. But coming up after